The reverse charge procedure is a relatively interesting construct. To explain the whole thing, I will elaborate a bit further. Basically, it is the case that when you write an invoice, you include value-added tax on that invoice. This means you have a customer, for example, and you bill them adding 19% value-added tax to your amount, and then you issue an invoice. Of course, if you have different tax rates, then you apply different tax rates, but this is the standard case. You receive the payment from your customer, and you remit this 190 as part of the value-added tax advance return to the tax office. That means we stay, and you have effectively handled the value-added tax processing for the tax office, and the money that the customer ultimately paid has been transferred by you to the tax office. That means, to put it quite harshly, you were like the go-between for the tax office and handled the value-added tax processing for them. However, there are some situations where this is different. Especially when your customer is a business located in the EU, the whole process changes. You will issue an invoice but do not show any value-added tax, because the service recipient is responsible for the tax debtor status. For the reverse charge procedure, this means a reversal of the tax debtor status. In other words, the tax debtor suddenly becomes the service recipient. That means you issue an invoice for 2021. And your customer has to account for 19% of that and must remit this 19% to the tax office themselves. This means that the customer then transfers $190 to the tax office themselves. If they are entitled to deduct input tax, they can reclaim this $190 at the same time. This means that no money needs to be transferred at all, but the entire value-added tax processing is essentially the responsibility of the customer and not you as the service provider. I always find it helpful to understand why things are the way they are with such regulations. At first glance, the reverse charge procedure seems somewhat peculiar. Why should it be done this way? Why should the service recipient suddenly be responsible for the value-added tax? It doesn't make much sense at first glance. However, if you take a closer look at why this is the case, it becomes relatively logical, and you can almost derive it yourself in a certain way. Let's stick to my example. We are talking about an invoice where I have a business customer in Austria, and I am advising this business customer and charging for it. This means I have now provided a service worth $1,000. Normally, I would now write an invoice for $1,000 plus $190 in taxes, which means I would send this amount to my customer, and my customer could then have these $190 reimbursed by the tax office as part of the value-added tax advance return. That would be no problem at all for my client, and it wouldn't be a problem for me either. It would actually be business as usual, just like it is always done. However, there are one or two parties for whom this is not entirely indifferent. So what actually happens in this entire value-added tax processing? I receive $190 from my customer and transfer that amount to the German tax office. This means that, in this case, I am remitting the tax to the tax office. My Austrian customer has a right to deduct input tax. He can reclaim $190 in the VAT return from his tax office. This means that the Austrian state, the Austrian tax office, transfers $190 to my customer, which would be fine for both of us. However, the party that has a big problem with this is the Austrian state in this case. Because the Austrian state pays $190, which ultimately ends up at the German tax office, this means that, through cross-border services, money from one country's pot ends up in another country's pot. And of course, the states do not want that. They want a clear accounting, and we do not want the value-added tax to suddenly flow cross-border from one state to another. One could also find another solution. For example, I could say, well, I have indicated German value-added tax and sent the invoice to the customer, so my customer should contact the German state, that is the German tax office, to get that tax back. I would remit $190 to the German tax office, and my customer would have to go there and repeat the $190. Admittedly, this is very cumbersome in everyday life. This means that in this case, my client would have a problem because they would have to file a value-added tax advance return in every country where they have service providers or consultants, which has been increasing in recent years due to internationalization. They would need to register for tax purposes in each country to reclaim the input tax from those countries. It would also be disproportionately much work. This means we have two options in theory. The first option is not favored by the Austrian state. The second option would not be liked by my customer. The third option is the reverse charge procedure. We say that for all these invoices that are cross-border for a business in another EU country, we simply issue net invoices and leave out the value-added tax. and the service recipient takes care of it. This makes it relatively simple. Everyone deals with their standard tax office, and in the end, I have my customer in my cash register, who can clarify this 190s or other tax rate in Austria with their tax office, therefore I have nothing more to do with it. We have solved the entire problem by effectively transferring the tax liabilities partnership to the service recipient. So again, when does this apply and why is it actually there? The reverse charge procedure applies whenever we have two businesses that are conducting transactions and are located in two different EU states. You should always consider whether the reverse charge procedure might apply. And why all of this? Well, to simplify the entire value-added tax processes and reduce bureaucracy. This way, each company only has to deal with its own tax office and does not have to settle anything involved across national borders. You might be wondering, so what? What does this have to do with my everyday life? When do I need the reverse charge procedure and when does it change something? It primarily relates to your invoicing. This means that whenever you issue an invoice to a business in the EU, that is, when your customer is a business located in the EU, you need to pay attention to a few things regarding your invoicing. And here are 4 things you should pay special attention to. The first is that you should issue a net invoice, as I have already mentioned. This means you do not show any value-added tax, but only have an amount on your invoice. The second point is that you should provide your value-added tax identification number. I recommend you do this for your regular invoices. This means when you send an invoice in Germany, you should include your VAT ID on the invoice. If you don't have such a number, take a look at this video where I showed you how to apply for a value-added tax identification number at the Federal Central Tax Office. And thirdly, it is relatively often forgotten that you must also include your customer's value-added tax identification number on your invoices. This means that you should find out this information beforehand before writing an invoice. Ask the customer for their value-added tax identification number. If you do not do this, you are not allowed to issue a net invoice. And fourthly, you should include some indication on your invoice that it is a reverse charge transaction. The most important term that you must use is reverse charge. A sample sentence that you can simply copy and paste. By the way, I have written it for you below in the video description. At this point, it is important to note that as the invoicer, you are liable for the value-added tax and for ensuring that the value-added tax identification number you have written on your invoice is correct. This also applies to the value-added tax identification number of your customer. This means that you have the obligation to verify whether the number you receive from your customer is correct. This is also the reason why the value-added tax identification number must always be listed in the imprint. Then there is a function on the website of the Federal Central Tax Office where you can check whether this number really belongs to the company. I can only strongly urge you to do this. Because if it turns out that this VAT identification number is incorrect, and this VAT processing did not even take place abroad, then you are liable for the VAT. This means that it is quite possible that you issued a net invoice, received no value-added tax from your customer, but still have to remit some if the tax number is incorrect. In conclusion, let's address the reverse case, meaning you are not the one issuing the invoice, but rather the one who is the customer and receives the invoice. You should also ensure that both value-added tax identification numbers are provided, that no value-added tax is indicated, and that the reference to the reverse charge procedure is included. Then, of course, it must be recorded accordingly so that it is reported correctly in your value-added tax advance return, because then you have to pay the value-added tax on this revenue and can also reclaim it if you are eligible for deduction. I have also made a video on this entire topic, which I will link for you in the top right corner. At this point, only if you do your own accounting is there usually the value-added tax rate for the reverse charge procedure. That is the one you use in such cases. If you are our client, you don't have to do anything at all. We will, of course, ensure that it is reported correctly to the tax office. I hope this video was helpful to you and gave you a bit of insight into what the reverse charge procedure is, why it exists, and what you should consider when issuing your invoices. Or just check out one of our other videos, like this one.